And we're going to do something really fun today. So before we get there, just very briefly, these are the objectives. I go through this every week if you're new to the stream. Today's trading principle is actually quite an interesting one, and it's a fun one. It's a really good way to actually test and develop your skills as a trader. Today's session, like I said, it's very unique because the way most of us look at markets is we always kind of go and look post the opportunity. We say, okay, well, there was 3 green candles, I got long, and then it didn't do the breakout and I lost money. Okay, so we do almost a little bit of a hindsight type analysis. What we don't do enough of as traders, and what we need to be doing more of trading, or sort of more of in terms of to improve our trading, is an approach of sort of a visualization technique. Okay, now hear me out. Just like in sports, okay, you take, for example, a basketball player, okay? He's now got to hit this 2-pointer or whatever, and he's visualized in his head a number of times in practice what making that throw would be like, okay? You can bet your bottom dollar that there's been a number of times where he would have been making that throw with noises around him, with distractions, with maybe air flowing on him, with all sorts of different types of scenarios. Okay, now, again, I know I probably haven't explained that as well as I could have, but in essence, you have to do the same sort of visualization approach with your trading. Okay, how does it work? Well, it's very simple. Okay, so a lot of us look at markets in this way. We go and we say to ourselves, well, market goes up, it goes down, it goes up, right? And what we do is we come and we say to ourselves, okay, well, what I want to do is I want to play for the breakout here because it's a momentum play, and I'm looking for the market to go up. Okay, and that's where we stop. So we go and we say, well, we want to be long on a break of this level, fair enough, so we do the first part, but we don't visualize and outlay exactly what we want to see on that break. Okay, and that's the visualization technique. It's the when we get to the scenario, what do I expect to see? Okay, what do I expect to see in terms of order flow, in terms of volume, in terms of volatility, in terms of correlated markets? What are all the expected outcomes I expect to see? Okay, now when we start to do it this way around, what you're going to start to notice is that when we do get to this point in time, right, your level of confidence and trust in your approach is going to be significantly higher. Why? Because you've almost covered all the bases. You've taken into account all the potential outcomes that could occur. Now, yes, obviously, sometimes it's not going to always play out accordingly. Right? In that case, what happens is you learn something new. In other words, it may break out differently to what you've learned, what you've come to learn over time. In essence, you add that to your catalog. Okay, and over time, what you're going to do is you're going to develop 3 or 4 or 5 different nuanced type of breakouts. Okay, so what we do is we do a back to front type analysis. Now, if that doesn't make sense, I'm going to explain it to you on a chart. Okay, so what we've got in front of you is a market. Doesn't matter what market it is, completely irrelevant. Right? Now, most traders would look at this and they would say to themselves, okay, well, clearly we can see sort of higher levels of rounding. Okay, I don't want to call it support, it's just a rounding. Okay, and equally we could see we had a nice rejection off the top, and today we had a gap. Right, so that's all we can see from this. We can't really make any other nuance from that other than the fact that the market is in very much a sideways position. Okay, if we were to draw a line at the close of this market session, we can see since the 18th of June to the 18th of July to the 6th of August, the market is unchanged. It's not moved. Okay, you can argue as much as you want that it's going up, it's going down. At the end of the day, the market's not moved in almost 3 weeks. Okay, that's the crux of the information. Now, what we have to do is we have to develop an approach as to what we expect to see potentially if we break that high, what we expect to see potentially if we break down below that low, and what we potentially expect to see if we test this trend line a third time, or maybe this resistance another time. Okay, so we have to develop expectations of what we expect to see. Now I'm going to show you how I develop my expectations. Okay, I don't just develop them based on, oh, I think it's going to be volatile below this trend line because there's a double bottom. Okay, it's far more nuanced than that. There's got to be a level of understanding that you can repeat over time. I'm going to show you what that looks like. Okay, so in order to do that, I have to get a 15-minute footprint chart up. Okay, the market you're looking at here, by the way, is the BTPs, which is the Italian bond market, and I'm going to show you what the footprint looks like in the BTPs. Okay, now the reason I utilize the BTPs is because, why I use the footprint is because it tells me exactly what kind of interaction is occurring at each price point. Okay, so I just want to quickly get this date in mind so I can go back. Alright, so we're going to scroll to the 25th of July. Obviously you can go and see this yourself, but if we go to the 25th of July, we're going to start off with that rejection. Okay, and the reason we look at it is because every high and low we make, every level that we make, every trend line that we make, it's made with a specific intention. Okay, it's all about the interaction between buying and selling. If there's very strong interaction at a level, right, we deem that as very strong support. In other words, there's very strong support from the buyers and equally very little intention or a reluctance from the sellers. Okay, and that's why we deem it to be strong support. That's why we deem it to potentially hold a second time and maybe even a third time. Equally, once that strong support is taken out, we expect to see stop outs. Okay, we expect to see the market liquidating longs. Right? And that kind of approach, we expect to see a different kind of price action, volatility, volume, etc., etc. Okay, so that's why we begin to develop almost an approach where we have intuition and understanding about what's likely to potentially occur. Okay, so I just want to get the just bear with me for 1 second, guys. Sorry. Okay, so this is the 24th. We can see the market comes up and a lot of buying. Okay, market backs off a little bit, continues higher the rest of the day. I'm not too concerned about this day type. What I am concerned about is this high made at 140.60, which is this one here, as you can see. So what we're going to do is we're going to focus on this high made at 140.60 on the 25th. Okay, because we want to see how this high has been made. Now, we can see that the market goes up with a significant amount of volume. Okay, not because I say, but because it's a significant amount of volume. Right, we can see the delta leading into that was nice and strong, so there was good buy side impetus into that, and we can see equally, right, quite a significant rejection. Right, 15-minute candle opened somewhere around the 36s, went all the way up to 63s, and dumped straight back down. Okay, so almost closed as a doji, almost as a shooting star type candle. Okay. So we can see there's significant interaction took place. More importantly though, notice what happened in terms of the footprint. Right? All we're seeing here is a significant order in the market. Not because I say so, but because someone sat there providing an offer. Okay, so there was a large time frame participant. He came in, he was offering at 54s, 53s, but equally he was selling into the bid. Okay, so this is the absorption that we're talking about. We have absorption taking place, and then eventually that seller starts to auction lower. Okay, so we can see it's a seller. Now note, I'm not saying you need to get short on the break of this 15-minute candle. What I'm saying is at the end of the day in your analysis, you need to be aware that there was a seller that intervened in the market. There was significant absorption that took place, and that seller not only absorbed, but he then went to market. And we can see that because price initiates the downside on significant volume. Okay. So that's the first takeaway. That's what we take away from the day. Now the reason we take that away is because that information is crucial the next time we come back up to this price point of 148.55. Okay, so the first hypothesis on the next day would have been, if we come to this 140, 48 and 55 area, I'd like to be short first time. Why? Because there was significant absorption there. The seller should still be there. Okay, I can keep a relatively tight stop. I'm looking for an entry on the 48s. Equally, I'm aware that that seller was very aggressive on the top, so if the market gives me some form of an access to a short side trade, I want to be short on day 2. Okay, and we continue on. So here's day 2, it starts off at 7 o'clock. We come up and we come back to that absorption point. Now notice what happens. Okay, the market comes, retests, right? Retests first up in the morning, once, twice, backs off slightly, and then goes straight through. Okay, so straight away we're starting to develop an intuition, which was that we had all this absorption, all this selling the previous day. The market comes back up to that price point, tests it a first time, second time, third time, goes through and punches higher. Okay, note the volume. Right, so the volume's telling us there were shorts stopping out on the break of that. Okay, short stop out, but what do we see again? Okay, significantly high volume, negative delta. Where does price finish? Lower. Okay, so a second time in this area of 48s to 55s, we're seeing a seller initiate. Right, and the market then moves lower a second time. Okay, third time. This time now, obviously, we had the ECB, so it was central bank. So obviously the market's going to be a little bit skewed. But third time the market comes up, punches aggressively higher on talk of lower interest rates, more QE, etc., etc. And this time, notice what happens. Okay, we get the initial candle. We then get 20,000 contracts traded. But what does price do in this 20,000 contracts? Okay, roughly speaking, a very narrow range. Given the volatility, a 16-tick range is extremely tight. 16,000 contracts, all that buying, but where's the market going? Okay, the net result after 45 minutes is unchanged. Okay, and that's that absorption again. It's all that effort coming in, all that volume. Prices trying to move higher, buyers trying to sustain, and all of a sudden, the buying's finished and the sellers initiate to the downside. Okay, so we've got a real significant top made, not just the first time at 48s and 55s, but also now around that 14s. Again, it's a large area, 14s to 57s. The point I'm trying to get across, guys, is that you've got to be looking at how these levels are formulated, not just, oh, there's a level there, I'm going to put a line. Okay, certain levels that are created by strong levels of selling, strong levels of resistance are going to be much better levels than just your regular put a line on a candlestick. Okay, now this is where it gets fun. All right, so what I want to show you is, I want to show you what happens over the next couple of sessions. So I'm just going to move this on a little bit. We can see that the base then of where the ECB started, so the base of that candle was around those 93s. Okay, equally. Okay, I just want to show you another wonderful little example of this absorption and auctioning. So